Good morning, everyone. I think most of you joined already, but the rest still is joining. But let us start. The rest will join us. The rest will catch that. Okay. Today we're gonna start talk about the capital budgeting itself. I already uploaded, if you notice from the model. So coming to the definition, the capital budgeting process. It is the process where you identify and evaluate the specific capital project, where the projects are bringing the cash flows to the firm for a longer period of time. We're not talking about the short run. We're talking about like long-term projects, like long-lived assets. So the capital budgeting, it is the allocation of the funds to the long-lived assets, to the long-lived capital projects in the future. So this is the way we allocate our funding. So when we say the capital budgeting, we talk about how the allocation of our budget to a certain long-lived project, to long-lived capital projects that will bring us in the future some cash flow. So this is the main reason why we're allocating our funds, why we invest in a long-term investment project. So the principles and the tools of the capital budgeting are applied in a different aspects of the businesses. And here some the groupings of the capital budgeting projects. We have a replacement cost project, expansion project, new products and services of new market, and mandatory projects. There are some projects that are like compulsory project that you have to perform. There is no way not to reject. So you have to run this project, and there are some other projects. So talking about the replacement cost is, as the name suggests, is you're trying to replace a certain machinery with a new machinery for some reasons, like maybe you found it out that replacing the old machinery with the new machinery, it will reduce the cost. So to buy that machinery, there is some project investment should be made, and that's why you make some analysis. Even in this case, you do you use the investment criteria to analyze whether you have to apply this or not. So this is one type of project. There is another way. It's like expansion project. If you're running like a, let's say, certain existing project, if you're doing a certain business and you want to expand your business, so there's a cost that you do it. So you have to calculate, like, have to get the incremental value of the calculation as well, like how much money you're going to generate and how much money you're going to spend. Either it's worth to expand your business or not. So there's way of to do it. The new products and services that are offered by your business, that's why you have to buy a new machinery to produce that goods and services. And still it requires the evaluation of the project. And there are some mandatory projects that like the project that are must to be run. The project, there is no way not, like I may not choose or I may choose. There's no such alternative. So you have to run it. Like environmental project. If you're like manufacturer company and you produce something, okay? And of course, while producing, while being a manufacturer company, it means that somehow you're polluting the atmosphere around you. So you have to run certain projects to clean up that after your production. And recently I was reading one article, guys. That article was related to manufacturer companies of the car producers, for the car producers. And we have electric cars as well, like, which is Tesla. You know, it's a very popular one. And what I found it out that they said, okay, the cars manufacturer, when you produce it, why there is a big need for the Tesla?
Due to it being environmentally friendly?
Yeah, to make the cars more friendly, not to pollute the environment, because we know that normal cars that we use on a daily basis, they're producing the carbon dioxide, like, which pollutes the air. So that's why it was the main decision by the government to support these electric cars. So this is another project, we can say, like it's a kind of mandatory project for the government to run it, to support it, because they have to think about the air pollution. And sorry for some technical issue. And so Tesla, what was the interesting in that article, guys, that okay, on one side we're trying to protect by producing certain cars to protect to make it more friendly to the environment, but on the other side, when you produce that car, the process of producing cars, it pollutes more the atmosphere than producing a regular car. So the process of pollution of the air is worse in a Tesla side than in regular cars. So this is the article was like kind of argument why we on one side we're trying to produce something cars that which will be very friendly to our environment. However, the process we have not thought of it, because the process when you produce it gives you even worse air pollution than, and not only the air pollution, the environmental pollution as well. So this thing that should be very careful when like they should be taken into consideration by the government. Like when you produce the cars, you should think about the process, because the process, it is very important around what you pollute or not. So this is another project. Now, I think it's going to be taken into consideration by the firms, like what are the process of producing the cars, and they should be least pollutable way of producing cars. So the basic principles of the capital budgeting, decisions that are made on cash flows are not accounting income, and they are relevant cash flow. They're considered part of the capital budgeting process, which are incremental cash flows. Incremental cash flows basically refers to changes in cash flows that occurs if the project is undertaken. So kind of showing the difference, how much money will be given as an incremental value, as a change value, when you run this certain project. So incremental cash flow is the difference in the company's cash flow with and without project. There is a case which is we need to consider as well as the sunk cost. Sunk cost is the cost that already occurred, and this cost cannot be recovered, and it cannot be considered as a part of the incremental cash flows. So what we mean by the incremental cash flow, when we get into more examples, we'll be able to understand what does really it refers to actually. So the sunk cost is the cost when you run a certain project, you invest your money in that, and it's a kind of investment outlay that cannot be recovered, and it cannot be considered in the part as a part of the incremental. So there's another terminology we should be aware of. Its externality is just an effect of the investment project that has on something else, and whether it's inside or outside of the company. So there is a certain project you run and it has some effect as well. So there's another terminology under the externality that was used, which is cannibalization, which is just an externality in which the investment decreases the cash flow elsewhere in the company. There are some external factors that affect the investment, like if you want to say in a simple words. And the cash flows that are based on opportunity cost, and all of you should be familiar with opportunity cost. Opportunity costs are the cash flows that the firm will lose by undertaking by a certain project. Like it's the best thing that you choose, but you forgive something else. By coming to the class, you're forgiving, let's say, sleeping, like you're not sleeping, or you're not watching a movie or anything else, like doing something on parallel. You cannot do these two things in the same time. Like You came to the class, so opportunity cost of coming to the class is to sleep. So which means that you have rejected your sleeping, but you decided to go with the class. So same thing with the investment project. Whenever you decide a certain project to run, you choose that project. But however, there is a cost for you, which is opportunity that you already rejected, that you could have taken that into consideration, but you're not doing it because you have selected another project. So this is the case that should be considered as well, the opportunity cost. And of course, it is very crucial as well not to ignore is the timing value of the cash flow, because the cash flow today is not equal to the cash flow tomorrow. This is second principle that you should keep in mind while talking about the cash flows. The third principle is the cash flows are analyzed after tax basis, like after payment of the taxes. And of course, the choice of the depreciation method is as well as important implication for after-tax cash flows of capital projects. So basically, depreciation item is a non-cash item. When we generate a certain cash flow, we should add it back, this depreciation item, depreciation value. And the fourth principle, the financing costs are ignored in the cash flow analysis because financing costs enter to the decision making through the required rate of return. So we have some decision criteria which are mostly most popular investment criteria. I'm sure you're already familiar with them, like NPV, like net present value, internal rate of return, IRR, payback period, discounted payback period, double AR, average account return, and the PI, the profitability index. Like it goes from the most reliable to the not to the least reliable, at least like it just the first comes as the most reliable. We're gonna discuss why it is most reliable, because these guys are having some pitfalls, some drawbacks that cannot be taken into consideration when you take decision on whether to run the investment project or not, because there's some certain cases that you have to consider only the NPV, but there are some companies, they still use like IRR, etc. We're going to talk about the pitfalls of the IRR, pitfalls of the payback, discount payback period. So what's wrong with this guy, with this investment criteria? We discuss in more detail a little bit later. So these are the main ones that are used as investment decision criteria in a capital budgeting. So coming to the net present value is just the present value of all incremental cash flows. Remember, what was the incremental cash flow? It is the change, it is the difference between with and without the project. Like, what if you run the project? What if you don't run? So there's a difference that you get the incremental cash flow, how much money you're going to generate. So it's the present value of all incremental cash flow discounted to the present and less initial outlay. And here we mean by initial outlay investment cost, that you have spent the money and you cannot recover it, you cannot get it back. Kind of sunk cost. As a formulation, you can hear like it's a summation of the cash flows, taking present value of it. We're taking all the future cash flow to the present value and the minus investment cost. And here it's how it's abbreviated, and the abbreviation are defined in here. But in here, the main important one, as you know, like NPV should be greater than 0 to be accepted. So this is the main conditions for the net present value. Like, in order to accept a certain project, whether it's expansion, whether it's a replacement cost, whether it's a mandatory project, whether it's producing a new product or services. So you do the NPV, but to accept that project, the NPV should be greater than 0. This is what you should take into consideration, okay? Here's an example is given. Consider that the Hoofdstad project, there is a certain project that you're running, which requires an investment 1 billion of initial outlay So your investment cost will be 1 billion with a subsequent future cash flows of 200 million, 300 million, 400 million, and 500 million. One question: is there anyone who does not know what is the present value, how to calculate the present value? Please do not hesitate, just type it that you don't know. You can type it privately, I don't mind. But if you know, I'm just following, okay? Please do not hesitate to stop me and ask the question here, okay? If you miss something.
Okay.
So we can characterize the project with the following end of the year cash flows. Like year 0 is always considered to be today. Like this is 1 billion investment. So this is our investment that cannot be recovered back. I mean, that cannot be taken, like if you invest it, you cannot get it back. That's it. You invest it, it's just a sunk cost. So you need to work on the future cash flows to compensate whatever you invested. So in the year 1, after year 1 of your investment, you will generate 200. After year 2, you generate 300. After year 3, you generate 400. After year 4, you generate 500. So in here, you are asked to calculate the NPV of that project if the required return is 5%. Guys, for simplicity, in this course and in this example, we're going to consider that required rate of return or cost of capital is 5%. So it doesn't change. It's same. Okay, we're assuming for simplicity, but in real life, it changes every year. Like in year 1, it will be one rate. In other year, it will be second rate. In the year 3, it will be different. In the year 4, it will be different. But for simplicity, we are assuming ceteris and paribus is just 5%. Now we need to calculate the present value. So what we're doing here, we will just take the present value of each cash flow, like present value of 500, which means that we're gonna bring them, all of the cash flows, to the year 0. This is what we're doing. So we're bringing all of the future cash flows to the year 0. This is our job. And we should take into consideration required rate of return, which is 5%. So $500 divided by 1 plus 5 divided to the power of how many years? 1, 2, 3, 4. So if your cash flow is here, so which will be 500 divided by 1 plus 0.05, and this all to the power 4. Very good. Somebody wrote it quickly than me. I'm just perfect. And minus investment cost, which is 1,000. Very good, Marlene. So this is what we do actually. Here's the solution is given in here, like 500, 400 discounted, 300 discounted, 200 discounted. Once
sorry, I have one question.
Yes, please.
If we'll get NPV, net present value, can we allocate it for each year for getting any special value, for example? For each year, for example, 219 dividing for 5 years, for example, for we'll get 54 for each year, for example, or it doesn't need.
Actually, what you do here, you have to bring them to the year 0. This is what we do, discount. But you say, let me just clarify whether did I understand you correctly? You mean take the separately calculation, or what was the question? Can you repeat again? I didn't get you clearly.
No, it's just my. This is just my question. Not related to this topic.
Okay, doesn't matter. I mean, just go ahead. Go ahead. It shouldn't be related. I mean, no problem.
I mean, we will get net value, net present value,
Yeah.
219 millions,
Yeah, true.
and it's for 4 years. I mean, for each year we'll get
I see. Now you want
55 million.
So you want to spread this profit like for each year, like proportional.
Yeah.
This one, okay, I got you now. It's in accounting system. There are different methodologies how you can recognize the profit. According to IFRS, according to the GAAP, the methodology of recognizing your profit is changing. For example, GAAP does not allow to go with proportional what you say, like 50%, what you're saying is correct way of thinking. It's directly related to the topic. Never think that it's not related. It's good that you raise this question. For example, IFRS, it's between what is the IFRS and GAAP. It's accounting standards that are used. One is in US, the other one is internationally, like in Europe and other countries. IFRS is in all the world internationally, but the GAAP is used in only in US. So we have GAAP and we have IFRS. Okay, accounting standards. I'm talking about this NPV is our profit, like net profit from the cash flows. But how should you recognize them? Do you recognize them today? Or do you recognize them when the time comes? Or do you recognize them at the end of the 4th year? When all the year passed. For example, IFRS says you can recognize when the time comes, like year 1 came, and it matches your profit, then you just put every year recognition. Or you can recognize them when it's year 4, then you can recognize it, all of the profit. So there's like a recovery cost recognition and there's a proportional profit recognition. Recovery cost, it means you just you cover your cost in that year, and whatever is left, you recognize your profit. So the method of recognizing in which year how much money will be left with you, it depends on according what accounting standards you're using and which methodology you're using to recognize the profit.
Thank you.
Okay.
Yes.
Is it okay to calculate NPVs through financial calculator?
Of course. But you are free to do anything. I provided the guideline for Casio for scientific calculator. I provided guideline for financial calculator as well, and we'll be using the Excel. When you will be given a, let's say, take-home exam, use anything. Just get me the results correctly. Just show me all your calculation.
Okay, thank you.
I don't mind what you're using. There are some websites, they provide it directly, like just put the numbers and they give you the NPV. Okay.
When we will start learning Excel calculation?
Wait, it's a good question. Now I'm going to, with this example, I'm just going to transfer this to Excel, and you will see how can we calculate the NPV in Excel in the fastest way.
Can I ask you?
Yes, please.
We should choose only one type of calculation, or we can use.
No. You can mix it. You can mix it.
Okay.
You can use 3 of them: scientific, financial, and Excel. It's up to you. But myself, I'm using Excel always.
Excel is fixed. You can just create a table and change numbers.
And it directly gives you the results. You can create your own calculator in the Excel. Very good. It's like beneficial. That's why I'm going to share with you the Excel as well, so that you can really get better Excel as well. Because in your work, if you're planning to work, let's say in KPMG, Pricewaterhouse, this type of companies, big 4 companies and other big corporations, they prefer that you really know how to use the Excel efficiently. Can you see my Excel?
Yes.
Yes.
Okay, great. So we have minus 1,000. This is year 0, year 1, 3, 4. 200, 300, 400, and 500, if I'm not mistaken. And we have 5% interest. That's it. And we are asked to calculate the NPV. What we're doing here, we just type NPV in here. We select all the numbers. Guys, in NPV, when you type the NPV in here, it only takes the present value of the all cash flows, okay? I forgot to put the rate, which is 5. Okay. And it takes only the present value of cash flows. Then you have to subtract this investment cost itself directly. So you have to manually subtract it. But we have a negative sign. We just make addition here and put it like this. So it gives me NPV. So it gives me in percentage, but I want in dollars. So did we get the same results? I think yes. Yes, we got exactly the same result. Let me repeat it again so that you can just follow it up. So present value, the NPV, when you just type NPV, it takes only the present value of cash flows, just present value. First, it asks to enter the rate. You can enter by manually, or you can just select the cell in here, like cell is A2. Just select it and put it, comma. Then you should select the value, the range of the value, the cash flows. You select it from C3 to C6, and you close the brackets. Plus, it's basically shouldn't be plus, it should be minus 1,000, your investment cost. But I put a plus because we have already put as a negative sign in here. So plus to minus, it will be minus. But if I put minus in here, it means that it's gonna add automatically. Minus to minus, it gives you a plus. So that's why I have to put plus here. So I select this variable. That's it. I press enter. My NPV is given here. So NPV is equal to $219. So you can play what our friend mentioned, why Excel is giving you some alternative way of doing, like more beneficial. You can change. What if my investment cost changes to 500? What happened to my NPV? You see, this is NPV. What if my investment cost becomes 1,500? That's a minus sign. You see my NPV becomes negative. What if my investment cost is the same, but first year cash flow changes from 200 to 500? You see it increases. By how much it increases automatically. So the increase happens automatically. In here, when you use your financial calculator, you have to re-enter everything from the beginning, the interest rate, everything. But in Excel, the best thing is that you enter once, and this is table, kind of a calculator to you. You fix this calculator for yourself and do all the changes you want in these variables as you want. Change in a way that you want it, you can get it easily, and you don't have to. So you save your time, first of all, and the probability to make the mistakes while typing, like type an error, is reduced because you see all the numbers. As I know from the financial calculus, I remember you cannot see all the numbers that you enter once you get the result. And what if you change the cost of capital?
Sorry, can you show formula again?
Yes, sure. Formula is here. First of all, with equal sign, NPV, one more time, NPV, it takes into consideration just present value of all cash flows. We're just taking the present value. That's why we need to subtract the investment cost manually. So open the bracket, it asks you to enter the rate. You can enter the rate manually, but I suggest you to enter with the help of the cell, because if you want to get the benefit from using the Excel by changing the numbers, the data set, to get the NPV directly calculated, just type everything into cell. So 5%, we selected, comma, and you're asked to enter the value range from C3 to C6. You just highlight and close the bracket. Minus investment cost. I'm saying one more time, saying minus because of here I have, let me put minus, okay, I'll make my investment cost here positive, assume here, okay. This is my investment cost. Okay, this is my investment cost, and these are my cash flows, future cash flows that I earn money. So I enter rate, comma, I select the value range minus investment cost. But more clearly, it's better to use as a negative sign in here to understand what's going on. So what we do in calculation, present value of cash flows minus investment outlay. This is what we're doing here. Okay. If you don't have any question, let me proceed with the.
Sorry, I have error in no, not this value.
Share your screen. Share your screen, please. Share your screen. Okay.
Yeah.
Can you make
I use this formula. It's 5%.
5%.
C3, C6. It's this one.
Check whether these numbers are all in the format of number.
I don't know.
Just select all of them. No. Just select the numbers from 1000 to 600.
Yeah.
Format cell. Okay. Make it number. Okay. Now calculate NPV from the beginning. Select 5, comma. Wait. Make it, no, it's not a comma, it's a dot comma, okay? In your case, it should be dot comma. Because the way of showing, yeah, okay. Select the range value. Okay, close the bracket.
And
no, don't put the dot comma. Don't put the dot comma. Plus investment cost. Yes. And it's okay, it's good. And it's in dollar. Make it dollar sign if you want. It's in ruble sign, I think, showing. No, it's upstairs. You can change the currency value. Okay, good.
It's the same.
Because
maybe percentage is wrong.
Wait. Marlene, you're correct because your first year cash flow starts with 300. Mine starts with 200.
The numbers are not right.
Your numbers that you typed is not correct. It's correct, but actually the way of calculating 200, 300, it should be ending up with the 500. 400, 300.
Yes, I understood. Thank you.
Okay.
Yes, thank you.
Okay, thank you as well. You can off your screen. Okay, this is where we calculate the NPV. Let us continue. Coming to IRR, internal rate of return, is the rate of the return on a project. Basically, IRR makes the NPV equal to 0 So it doesn't matter what will be your IRR, this rate will make your NPV equal to 0, which means that you will be on a break-even point. Do you know what does break-even point mean?
When your costs equal to your profit.
Very good,
So when
Tamiris.
no profit is
Very good, very good. That means that your profit and cost, they are equal. So you are not making profit, you're not incurring any cost. You're equalized. So you're in a different position here. So this is the rate which is used to equate your NPV to 0. So which means that future present value of your cash flow that you generate will be equal to the 0, will be equal, NPV will be equal to 0, which means that the future present value of your cash flows that you're going to bring to the year 0 will be equal with your investment cost. If IRR is more than capital, required rate of return, cost of capital, the capital should be accepted. If IRR is less than cost of capital, you should not run this project. You should not invest. Okay, this is the investment decision criteria for you. But however, you should know that when your NPV when your NPV is equal to 0. So in here, same project is given. Okay. Here how it's calculated. You can use your financial calculator to calculate, or you can use to calculate the Excel as well, Excel spreadsheet. So using this, it will give you a kind of hint. Let us continue with Excel. So here was the NPV. Now let us calculate with the IRR, internal rate of return. We know that IRR makes our NPV equal to 0. Equal sign, it's very pretty easy. We just type IRR, open. So we just enter the all values, okay? From C2 to C6. Close the bracket and press enter, okay? It's 13%, not 13, but let us check whether it's correct. Yes, it's correct. So what we do here one more time, equal sign, I type IRR, open the brackets, the value range from C2 to C6. Close the brackets. I get my IRR. So at this percentage, my NPV will be equal to 0. So let us try our new NPV. NPV with IRR. NPV with IRR. What will be the sign of NPV with IRR? So again, NPV, open, rate. I'm using this rate, guys. This time I'm using 12%, not 5%. And I enter the range, close the bracket, minus investment cost. I should get 0. If I don't get 0, it means I made a mistake somewhere. So my NPV IRR is equal to 0. So which means that at this rate, my NPV will be 0. So what kind of information you can get, a very beneficial information you can get using the IRR. So the information is that, you know that, keep in mind that whenever IRR, it makes the NPV equal to 0. So if you remember the investment criteria in here, guys, go back. If IRR is more than required rate of return, then you should accept the project. You should run the project. So your NPV will be positive. This is what you should keep in mind. If IRR more than cost of capital. If IRR happens to be lower than R, then be sure that your investment is not feasible. Yeah, you cannot invest in that project. Let me explain by mathematical calculation. So we have 12.82. Any rate below this, first of all, before coming to this, I would like to ask a question. What is the relationship between interest rate and the value of the NPV? There is an inverse relationship. If you increase interest rates, that will reduce profit. If you reduce your interest rate, that will increase profit. So now our required rate of return is 5%. And our IRR is 12%. 12% is higher than IRR. So it's higher than 5%, which means our NPV is positive. If I put, let's say, 13% in here, tell me, what do you expect our NPV to be? Positive or negative at 13%?
Negative.
Negative.
Negative. Very good. You know, now you got the point. You got the point with the edge. Like if you go in beyond the edge of 12.82%, then you will get a negative interest rate. If you go below that edge, you'll get a positive. So if I put my NPV, change the rate to 13%, you'll see my NPV will be negative. So you don't have to calculate. You will see that that's why the companies, they use IRR. They say, okay, look, if we use the IRR, it's better. Just you don't waste the time on calculation. We can easily understand what it is. There is a positive or negative NPV. If you are given, let me give you this example. Let's say IRR is equal to 15%. Cost of capital or required rate of return is equal to 16%. Would you accept this project?
No,
No.
because
No.
Why?
rate is higher.
Is your NPV negative or positive?
Negative.
Negative.
Negative. Why? Because required rate
Rate
of
of
return.
return is more higher than IRR.
So if you put that rate, it will be lower than 0, which will be negative. Very good. So this is what we can get information using the IRR. However, there is some big pitfall in the IRR. We're going to talk a bit later about it. But for this time, you should know how to use the IRR with comparison with NPV. Let me just take a screenshot. So this is where we calculate the IRR. So you can use your financial calculator to calculate. You can use Excel, whatever you prefer. You're free to do. But however, using the scientific calculator like Casio, it's going to really complicate your life, because what you will do, you will try and error. Just what if I put 12% in here? Okay. Then what if I put 12.1? What if I put 12.2? Until you reach this 0.12826, like trying and error to get your NPV equal to 0. Maybe you will spend half of your life to get NPV equal to 0 by trying and error, but it's better to use the Excel spreadsheet or using the financial calculator. But Excel spreadsheet will give you like it will be like, it will save your time. You will calculate in the fastest way in contrast to the financial calculator. So payback period, it's another investment criteria. It measures the time, the length of the time, how long it takes to recover your initial investment cost from the future incremental cash flow that it is generated. Like we're given, let's say, My throat got thirsty. Okay, anyway. So in here we measure how to calculate the payback period and how long it takes to cover your initial investment cost. So your investment cost is $1,000, and what you do in here, you just try to calculate how much you generated each year and until you just cover your investment cost. So from the first year you generated $200. That covers only 20% of your investment cost, which is left is 80%, which is $800 in here. So you need more $800. So you go to the second year. You take the second year's investment cost, which is $300. In total, you already used $500. You covered only half, and the half left, minus 500 left to cover it. So you proceed to the third year. In the third year, you use the whole amount, 400. However, you cover only 90% of it and left only 10% uncovered. So $100 should be taken from the fourth year. But in the fourth year, you generate $500, which is much, much more than you need it. You need just only $100. So you get this 100 from here and 400 left. You don't care about whatever is left, but you will just get this $100, whatever you needed. That's it. Your aim in payback period to pay back my investment cost. I don't care what is the after. What will be the after the fourth year, fifth year? Well, it's gonna be like triple of cash flow what I received in the first year. But for me, it's most important thing is just to cover how many years it takes to just finish my investment cost, to cover my investment cost. This is the most thing that I'm caring about now. So it may take 3-point-something years to finish your investment cost. Why we don't take the 4-year totally? Because in the fourth year, we do not consider the full amount. We consider just part of it, maybe 25%. That's why we need to get like 3.25, I think it's gonna be like 3.25 years required to cover your investment cost. So in here, the most and crucial case is you need to find out how many years it takes to cover your initial cash outlay. Here is an example is given for the payback for two projects, Project X and Project Y. And it's like given, we can calculate, let's say $100 in here. So we can see in here how long it takes. Like if you use 100 and you get in the first 20 and 50, you just cover 70% and remaining only the 30%, which is coming from the third year. You will have only left 30%, like 30 pounds or $30 left to get it from here, which is $15 will be left back. However, that means that you are not using fully the third year for the Project X. It will be like 3-point-something. So 2-point-something years. But when it comes here, is the same because the cash flows are same. So in here, if you're giving a case that which project would you choose?
X project.
No, why you can choose the X project?
Because
There's no difference. Oh, sorry.
Because of what?
Because at the last like 4 years we will get like 60 funds.
Okay, here we assuming that very true. If you do not, but payback period, they don't care about the further coming cash flows. They say we need to just cover the cost. That's it. So according payback period, you will be in a different position. You will not know which project to choose, X or Y. You'll be in a different. But if you take into consideration the cash flow, the future cash flows, then surely you should go with the project X because it generates, as our friend mentioned, it generates like 60 pounds. Okay. Any questions do you have how to calculate the payback period? I think it's just simply straightforward and you should have already learned from your finance courses. If you don't understand, please feel free to ask and write it. I'll be pleased to explain it again. Okay. It seems that you're all...
May I ask one question?
Yes, please, Vladislav.
How to calculate cash flows and why we have choose project X? I haven't understood that situation.
Okay, why we choose, look, in payback period, he said it is just to cover the cost. In this year, we cover the cost in both projects, isn't it?
Mm-hmm.
We cover it. But whatever comes after this year, the payback period doesn't care. It ignores it, just take into ignore position that I don't care, it's 160 or 200, it's just ignore. But in reality, if you're a manager, if you're an owner of the company, for you, it is very important to know how much money you receive in after that. So this is like a disadvantage of using the payback period because it ignores a future cash flow after the recovering the cost. If we were in the position that we don't take into consideration that the pitfall of payback period, we would be in a different position. But if we take into consideration that the payback period, it ignores the cash flows, future cash flows, then definitely we should go with the project X because it brings you more cash flows. Why I should go with the same investment cost with the project Y when it brings you the less investment, future cash flows?
Yeah, got it. Thank you.
Okay, and another disadvantage, this was the first disadvantage. There's another pitfall of the payback period. Who can tell me? What did you see in NPV and you cannot see it in payback period?
Time value of money.
Yes, very good, Alman. It's a time value of the money because the $1 today is not equal to $1 tomorrow. So that's the thing that we should include while taking into consideration the investment decisions. So that's why they decided to modify the payback period by adding like discounted payback period by taking into consideration the time value. Is just showing the length it takes for cumulative discounted cash flows to the equal initial outlay. In other words, it is the length of the time for the project to reach the NPV equal to the 0. So in here, we're given project X and Y, same. And discounted cash flows, we discount them, each cash flow. And the same procedure, we just exactly, the calculation is the same, the logic is the same, how long it takes to cover the investment cost, but with discounted cash flow. So these cash flows are discounted to the present value with a certain discounted rate. And now we can see like 1945, you're adding up till you cover your investment costs. So if you discount it, look, in the first project, in project Y, it is not enough cash flows generated to cover the investment cost. Can you see it? Yes. So you need more, or it is enough. Like 20, 45, 65. Yes, yeah, it's enough. It's like, it's just, I don't like it's just on the edge to cover the cost. But still in here, if you investment cost, so that's why you decided to take the investment cost, take the present value of each cash flow and try to use the payback period in this method. So this is the main difference how they do it. They discount each cash flow, they're adding them up, and they try to see how the investment cost is recovered in which years. If you don't have any questions, let me move to another investment criteria. So far, we are introduced to you 3 investment criteria, 4, sorry. NPV, IRR, payback period, and discounted payback period. So Coming to the fifth of investment criteria, it's average accounting return. Is the ratio that average, it measures the average net income from the project to the average book value of the assets. So there's a formula. And how do you come up with a certain decision to invest or not to invest, or to undertake certain project or not to go with that project? Is you put a target rate. Let's say my target rate is 20%. And if you put this target percent and you try to calculate your average account return, if your average account return becomes to be higher than your target rate, then you accept the project, you run this project. If you come up with that your average accounting return is lower than your target rate, then you do not take that project, you do not undertake that project. This is the how we come up with the decision to invest or not to invest.
So, Professor,
yes.
previous one is like the return on assets, yes? It's similar like the financial ratio.
It's a kind of, yeah, we can relate to the ratio, return on asset, but very true, but still we're using like average of net income and average book value.
Okay, thank you.
Look, in here I want to underline one more time. When you say the return on asset is net income over the total asset, isn't it? Yes. And in here we're talking about average book value of long-lived assets. When you take the total assets, fixed assets, the assets like long-term investment projects, because we're talking about the capital budget. So we do consider only the assets that are in long term. We don't take into consideration like the current assets. And still is not reliable and doesn't give that much information as we can get it from NPV.
Sorry, may I ask,
Yes,
what
please.
is book? How find book value?
Book value is the historical price of buying. If I purchase my computer, let's say for $200, I record it in balance sheet, I record as a $200. So my book value of that asset is $200. You know, there are some assets in balance sheet that are recorded at book value, and there are some assets that are recorded at market value. Those assets are like, most of them are fixed assets. For example, they don't change, like long-lived assets. It's better to call them long-lived assets rather than fixed asset. Long-lived assets. But these are asset types like machine equipment, building, machinery, office supplies like computers, tables, and everything that has got the depreciation. But market value assets, we can give you securities, financial securities that you buy to trade it in a short term, like which are in the current asset. Because when you buy, let's say, bond, even it's a long-term asset, but is the bond, do you all know what is the bond?
Yes.
Okay. Yeah. And the bond value, or we can say bond value, or any financial security, they change in value daily. So the balance sheet is updated in the case of the bond and the other financial securities, like marketable securities, like trading securities. Like you buy this financial, you know, this accounting principles, accounting standard is a bit differentiated, like in terms of recognizing how you should record in terms of book value and market value. But the book value is the first purchase price. I can give you in this way the definition, like how much money you pay to buy a certain long-lived asset. I paid for my truck, I bought it, I paid, let's say, 2 million tenge, and I will record it as a 2 million tenge in my balance sheet, that it will be my book value, that truck. But if I buy financial securities, and financial securities are changing in terms of recording them as a book value or market value, it depends for what you're buying. You're buying it to held to maturity or you're buying with the purpose to resell it. If you're buying with the purpose to resell it, then you should record it as market value. If you're buying with the purpose to hold it till the maturity, you should record it at its book value, at its par value, the bond. This is how it goes with the principles of accounting standards like GAAP and the IFRS and so on. But we know about talking of book value, about the long-lived assets. We buy them to use it to depreciate till 0. So that's why we record them as a book value. This book value is given. So how do you take the average book value? It's very easy. It's just if the cost of machinery, let's say, is $200,000, and we are using straight line depreciation, which means to 0. That means that 200,000 plus 0, and this all divided by 2. That will give you the average book value. If depreciation is used methodology as straight line depreciation 0, okay? But in our cases, for simplicity, we will not use other depreciation methodologies like double declining or accelerating and so on. We're going to use only the straight line depreciation methodology only, which is equal directly to 0 at the end of the value. So which means cost plus 0 divided by 2. This is always the case. You will get 100,000 as average book value. And you have net income, let's say for 2 years or for 3 years. This 3 net income like 200 plus 220,000 or 200 plus 200, 120 plus 300, and this all divided by 3. You will get the average of the net income. This is how we calculate. We're going to get into calculation in more detail after when we complete this lecture. I think I'm done. Yes, guys, with timing.
Yes.
Okay.
Yes.
Sometimes you guys stop me, please, when I'm just over the timing, because
Okay.
I don't notice it. Okay, thank you for your coming, for your attending. See you then.
Thank you, Professor.
Thank you. Bye.
Thank you. Goodbye.
Thank you. Goodbye.
Thank you. Bye. Thank you.
Thank you. Bye.